Sell in May and go away. Looks like some institutional investors are actually considering this over the course of the last couple of days. So with that, we're going to dive into 13 Market Moves Daily for May 7th, 2019, Tuesday. Guys, congratulations of those of you who fearlessly jumped in on the call side, because I know emotionally it's a very difficult decision. When you see the markets drop, that's the last thing you want to do, especially if you're a hardcore bear and you're inclined to just, take the bearish bets. So it's difficult, but the payout was pretty nice. So give yourself a high five if you did get that call side trade accomplished and reversed it timely to the put side. So top observations from yesterday and today, guys. Bearish gap created pre-market yesterday was not closed by the end of the day intraday, which is, come on guys, you know the answer to this one by now. It's highly bearish. Number two, markets worldwide showing signs of bigger drop on the charts. We're going to take a closer look. Number three, lower sell volume is a concern today pre-market, telling us that it's not a crash yet, that the bulls are still fighting, but we're getting very, very close. So we're going to take a look specifically at what to do with this low volume situation. We're going to take a look at a couple of multiple scenarios. Number four, what I want you to do today is add puts at the critical levels on the way lower. So try not to add a ton of puts unless we're breaking below these critical levels. And real quick, again, they're 29.26, 29.10, 28.83.5, and 28.46. I want you to focus on adding some puts at the market open. But make sure you're using our steer step strategy when you guys are doing that. For those of you that are new, you're not familiar with the steer step strategy, send us an email. We'll send you a link to a video who's going to show you how to steer step into the trades and scale out of the trades. Some of the free bonuses we've recently offered to our subscribers, just make sure you really take your time to study them and go through them, because they will help you identify some of the best ways that I've learned over the years how to get into the trades and how to get out. And from talking to a lot of traders, guys, it seems to be a very crucial aspect of how much you're actually locking in gains. So focus on that today, focus on that this week, get additional information, study the extra bonuses we've provided for you guys, and just, if there's any course out there that you have not completed yet, click the links below. Make sure going into this week you study up, you get ready for these crazy markets, because it is about to get pretty crazy out there. Okay, so here's what we got. Hong Kong. Hong Kong closed the bullish gap. Look at this chart, guys. Do you see this bullish gap right here that was created in April on the way higher? Well, yesterday this bullish gap was closed. See where we closed on in Hong Kong? Barely hitting on this blue line, kind of hanging on the edge of a cliff here. And ultimately, it could resolve into Hong Kong visiting this level, 28.5, possibly 28,000. So the fact that this bullish gap on the way higher was closed yesterday is significant. If we're to investigate further, surprise, surprise, the German stock index is doing the same thing. See this bullish gap that was created right here, guys? After creating a series of bearish reversal candles, German stocks tank as well, and they closed this bullish gap that was open. Also, if you pay close attention to the MACD, right, it's just about to cross the orange line on the way lower. The black line is about to make this death cross, if you will, and similar observation as we have right here. So it seems like what we're seeing in Hong Kong spills over to the markets in Europe. And from there, who's next? It's Japan. See, I've given you two examples of two worldwide indexes that already closed the bullish gap. I think Nikkei, the Japanese stock exchange, is to do it next. See this bullish gap that was created right here. Similar to the DAX, the German index, right? We're getting a series of bearish reversal candles here. Ultimately, it will resolve in this gap closure. As much as this index is trying to hang in there around this 22.3, 22.4 area, it looks like it will resolve into a break lower, and therefore it will also close that index. And coincidentally, if you look at the MACD, it's already pointing to the fact that it is about to do it. We also got a confirmation at the weaker top right here, double top, on a shorter time frame on Nikkei. So ultimately, Nikkei dropping lower will also, finally, the last index that has struggled to break lower is finally going to do that. And I think it could happen today. And interesting observation, been keeping track of copper for some time now is an indication of where really the economy is going worldwide. And copper has just formed a very bearish pattern. For those of you that have taken the charts, divergences, and pattern recognition course, guys, what does this look? This looks like a phenomenal head and shoulder pattern to me. And what's interesting is this top is so prolonged. When you see like a top spike in some stocks, when we're talking about some of these head and shoulder developments, they actually don't last very long. Well, because this top is so prolonged, it actually could tell us that there's going to be a prolonged drop in the price of copper. So temporarily, we could go sideways, but ultimately it could result in copper prices crashing all the way to these levels of December, back to these levels of 2.55, 2.6. Now, that's not going to be a very good indication, not for China, not for US, not for any indexes worldwide. So, as we pointed out in some of the prior videos, these bearish reversal candles, what do they lead to? They lead to a drop-off, and we clearly got one right here. Well, there is another leg of the drop-off that is likely to develop, and we're going to pay very close attention to that and see how that chart progresses. So let's take a closer look at a bunch of charts and the market moves. Had a lot of questions yesterday. Okay, are you logging it as a 4? Because it sure looked like we had a pretty strong bounce going into the close. And yes, that is a correct observation. So the correct way to actually log this, the way we did it, is we logged it as a move 3 with a clear behavioral characteristics of a move 4. So if we're to take a look at the chart, you see that gap that was created pre-market? See, that gap was never closed. And if you study the 13 Markets Move Formula course very thoroughly then, and you pay attention to the chapter that talks about the Market Move 4, in Market Move 4, we will actually, towards the very last part of the day, we'll have that final push higher, would actually close the gap that was created pre-market. In this case, it tries to, but it fails to do so. So we're still, even though a lot of the losses were erased, okay, we still couldn't close this gap. And so this is actually a very bearish observation. So 2-day sequence is going to be 1-3. 1-3 looks like this in the chart, guys. Here's a clear 1 move on a Friday with the positive job report and the positive reaction to that job report. Here's your gap lower. Here's your typical move 3 type behavior, and then we pick up the higher low right here, and then we move higher throughout the day, and a smaller sell-off going right, losing about 8 points going into the close. So clear behavior of a move 4, like the bulls are actually coming in, and they're really trying to move this market higher. At least they're certainly trying to support the market at these levels right above 2,900. Now, the importance is this. The fact that this gap was not closed overall gives the bears the dominance, at least short term. So today is a very crucial day because we're likely to create another gap lower. So at this point, we're heading into a series of gaps lower, which are clearly becoming more and more bearish for the market overall, and for some high beta stocks like Amazon and Facebook and all the FANG stocks, all the technology stocks. Clearly the same behavior we're observing in a lot of Chinese stocks, cloud stocks, and so on. So the usual suspects that we're targeting for shorting, guys, these observations right here, you don't necessarily just have to trade SPY puts or Q puts. You could just really apply it to any stock that has high beta. Okay, 5-day sequence, 4-9-2-1-3. So again, we have a situation where predominantly the bears take over the market, at least for now, short term. Can you actually identify the pattern that is now highly repetitive by looking at these 5-day sequence, guys? We've been talking about the pyramids, the tops, Looking closely, I specifically did not highlight on this chart. Is there something in particular that jumps at you by looking at this chart? Specifically zoom in at 3 instances. Well, the 3 instances I would like for you guys to focus on is this. So as the stop is formed, you see it kind of drags its feet and it's being formed, but look how quick and how sharp this drop happens when it comes in. Same situation around here, right? Look at this part. Look at the red part of the chart. And so the same thing we're getting here. So anytime the market looks like it's doing this, it's followed by a sharp drop, confirmed by a huge sell-off. We've been observing this behavior now for multiple weeks, but it seems at this point to be really intensifying, and these drops in relation to the moves higher, when the top is actually being created intraday, these drops are much more defined, they're much sharper, and they are indicating that a bigger drop is indeed in the making. So looking at this chart pattern, top, drop, top, drop, top, drop, what do you think is about to happen next? Well, I'm not sure exactly where the market is going to open, but so far pre-market, as I'm recording this video, we see another 2 confirmations of pop and drop or bounce and drop. So when you guys hear these messages from me, short the bounces. Just look at this chart and it should be very clear to you what to do and when. So here's your pop or the bounce, here's the drop. Here's your bounce, here's the drop. Here's the bounce, the drop. So far pre-market, we've had another bounce followed by a drop and another bounce followed by another drop. Do you see now why shorting the intraday tops and bounces actually makes sense? The markets within a few points from their all-time highs. You don't want to be a crazy bull, believe in everything that you hear in the media right now. You want to just stick with this strategy, but you want to take your execution up definitely to the next level. So focus on catching the tops, collecting profits at the drops, expect the bounce. You don't necessarily have to play these moves on both sides, because at one point we will get them consecutively 2 or 3 days lower, and if you're trying to play the moves on both sides, it's going to be a dangerous game. So what you want to do mainly is just stick with the same strategy. Bounce, you short it here, collect the profits. Bounce, you come in, you short, you know. So there's no need to be greedy. There's no need to say, oh, I'm going to nail every move here. So don't be doing this. Bounce, you buy calls. Occasionally it makes sense. There were clear signs to do that yesterday. We do not recommend certainly buying no calls at the market open today. As a matter of fact, we do clearly suggest buying some puts, not your whole account full of puts. You know, just we clearly recommend buying some puts at the market open and then watch for the key critical levels. Now, here's a very important chart that I want to bring to your attention. It appears that there is a death cross in the making. Short-term death cross. You won't find anywhere. I just drew these lines. So try to stay with me as I'm trying to work for this example. So look at this top right here. Top followed by a gap down. We get back up to this top followed by a gap down pre-market. Reversal. Notably, this red sharp sell-off happened yesterday after market. At 2 a.m., the market tried to rebound. You see this 2 orange, I drew them in orange parallel lines. So the sell-off that was happening after close, after the market yesterday, was followed by another bullish behavior about 2:30 in the morning in the futures. And what happened, what actually took place is there was another top created right here. Now, if you drew a line, clearly we're getting a downtrend here. We're getting a downtrend of series of lower highs. If this trend was to continue, which there's a number of things that tells us it will, pretty soon, okay, we're going to have a situation where we're going to have a cross right here. And once this cross happens, we're going to get a sharp move. And likely we're going to get that sharp move to the downside, observing all behavior that we have been observing on the charts over the course of the last few weeks. So another way to look at it is you're getting a series of higher lows, right? Here's the low that was set pre-market yesterday at 28.83.5. Here's another higher low. Here's another higher low. Well, they're about to meet. The lows and the highs are about to meet, and we're going to get a cross. Considering this behavior pre-market, overall it's highly bearish because the market yesterday tried to run up to this level. After the market had sold off, it created another top. It didn't even try to run at this level of 29.40. It could have easily done that, but look how quickly the gains were surrendered. So this is a characteristic. If we're to break it down into miniature steps or miniature moves, what is this, guys? That's a move 11. That's one pyramid. What is this? That's a move 11. That's another pyramid. So you got two 11s happening between the market closing yesterday and between the market opening today. You got two 11s creating two lower highs. That is bearish. Let's take a look at the VIX. VIX numerically is high, even though it did close at the lows yesterday. VIX popped to 18.8. Intermediate about 17, finished at 15.46. The uptrend in the VIX is confirmed, however, and buying out of the money puts is justified on market bounces. So here's what we've noticed yesterday, right? It was a market move 11 in the VIX that was going to surrender some gains, was suggested coming in, buying the VIX, calls at around 16 level. It actually dropped slightly below that, but so far pre-market, it's very solidly about that 16. At the point I'm recording this, guys, it's at 16.67. And looking at this, for those of you that are really trying to understand the chart patterns, guys, what this is, it's a reverse head and shoulder. Now, charts divergence scores, we talk a lot about, the head and shoulder. Well, there's such thing as a reverse head and shoulder, which is actually bullish. So remember yesterday, when this was taking place, we were identifying this move 11, saying there's going to be a pullback, but now it's creating a reverse head and shoulder pattern, which is bullish, telling us the VIX can easily revisit these levels of 17.18 very easily today, and definitely possibly break out even above these 18.8 over the course of the next 3-4 days. So remember, these reverse head and shoulders pattern, you can observe them on longer time frame, shorter time frame. In this particular case, we're observing this pre-market. Between the time the market closed yesterday and pre-market today, it's a pretty well-defined pattern, especially with a gap up higher in the VIX right here. This makes it for a pretty bullish trade, and especially what's important, right? Our definition of VIX, high numerical VIX, is above 16, and that's what we got. The VIX is holding this 16 level, so I'm thinking we're back to this support level. Now 16 is going to be the level of support for the VIX. From here, we're looking to hit significantly higher levels. We're clearly targeting this level of 18.8. It would not be a bad idea if you were buying VIX calls yesterday at 16. Once it hits this level about 18.8, take half of the position off. There could be a double top. We could see maybe a pullback. But also, if it moves higher and you see the volume is coming in on the sell side of the market, we can just zoom through this thing way higher, maybe to 2021 level. Okay, so just keep those things in mind. Where should we be buying puts? Again, we're observing these tops that were created. And the interesting thing, here's the sell side after the first stop, after the market closed yesterday. At 2:30, the bulls are coming in. They're trying to support the market. Observe this support level right here, because this is going to be important when you're trying to buy puts today, guys. So, as you can see, after the market makes the sharp move lower, it creates this first low, second low high, second low a little bit higher. And so this coincides with a level about 29.10, 29.14, 29.11, 29.12, right around that area. So ideally at the market, wherever we're going to open up, let's say we open up at 29.15, buy some puts, but just a few. Where you really want to buy some more puts, if you see the sell side volume is increasing and we're breaking below this 29.10 level. So if you see the market at 29.09, 29.08, 29.07, load up on puts, because the next stop is going to be somewhere around here between 28.80 and 28.90. Now don't be in a rush if we are trading above this level of 29.10, do not be in a rush to pull the trigger. As clearly stated earlier in the beginning of the video, one of the concerns is stocks are dropping today on lower volume. As the reference point, for example, Amazon, last time I looked, was only down, 10, 15 bucks on a volume of about 30, 40,000 shares. That is not bearish. Okay, as a matter of fact, we can almost look at it as a bullish sign. So consider the fact that once the market opens, we may not get an immediate sell-off. We may see something like this. We may see the bulls come in again trying to pick up the market. Okay, we could get a sell-off pretty quick, but it may subside right around these levels. Maybe we can hit 2,900 and it can pause there for a second. Ultimately, we will test this level of 28.83, 28.85 roughly in the next 24 to 48 hours. But what you don't want to do, you don't want to jump out seeing that the market is getting lower again. You don't want to jump out and build a lot of puts right out of the gate. You want to stair step. So if your goal today, let's say, is to buy maybe 20 contracts, then buy 5 at the open. If the market, you see, hesitant to move lower, then wait till it bounces back to that level of 29.20, 29.26 as discussed in the video yesterday. Add 5 more there. If you see it going to 29.35, but the buy volume is low, add 5 more right here. Ultimately, the level that we're targeting, we will keep buying puts in expectation of a bigger drop all the way, if the bulls are buying the market on lower volume, all the way to 29.49. If the market jumps above 29.50 on higher volume, we'll have to close the position. But the losses at that, they're not going to be great, because if you stair step, in other words, one thing if you just jump at the market, let's say, as I took this picture pre-market, at that time it was at 29.14. Let's say the market initially tries to do this, like it did at 2:30 in the morning, and the bulls come in, and they try to scoop up, the volume is less, and so maybe we can move back to 29.30 temporarily. Well, imagine if you buy a huge position right here. By this time, I mean, you're going to be having a heart attack because your losses are going to be big. So just simple point, guys, right? Stair step. Buy a few contracts here. Buy a few contracts right here. If we're moving here, buy. But no, we're buying it all the way to 29.49 in expectation of a drop in the next 48 hours right here to 28.83. And if the volume does come in strongly, we could actually break that. And the next level is going to be 28.46. Okay, with that said, guys, here's the next market move. Clearly, the bulls are not killed. They're still trying to support the market. We are likely to open with a gap lower, which is a nice setup for move 3. And it would confirm the pattern that we're observing on some of the charts earlier, right? Where, the market bounces, it gaps lower, bounces, gaps lower, bounces, gaps lower. That's very bearish. That's the environment where you want to keep your positions overnight. So, guys, congratulations to those that fearlessly bought the puts at the 29.20, 29.26 level. You kept them overnight. You're starting to see now how this works. The market gaps down. You get a chance to collect some profits. You come in hopefully on the bounce. You get some more. You keep them overnight. The market gaps the next morning. Okay? And, just do it with the comfort level. Don't put your whole account in it. You should know what your comfort level is for keeping some of these positions overnight. So clearly, if you're stressed out and you can't fall asleep, that tells you that your position is too big. So cut it down to your sleep level. That's the easiest recommendation I could suggest to anyone. So just adjust your positions accordingly and take advantage of the intraday bounces. Now, clearly, the bulls are not gone, so we still calculate just like yesterday. We could see this behavior of a move 4. Okay, but the probability of that is diminished. However, the only concern and the only reason we even considering that these 4 has a probability of happening is because the stocks pre-market are down on low volume. We're not seeing crazy fear. Like stocks like BABA, they should be dropping $10, $15, but they're not. I mean, they're only down like a couple of bucks, and the volume is not super strong. I mean, stocks like Microsoft down like 50, 80 cents. I mean, that's not, number one, it's not a big move. Number two, it just, the volume is still not there. So until we see some strong volume coming in on the sell side, we're not going to get a bigger drop. So you got to target these levels really precisely if you want to collect profits daily, guys. So again, the key takeaways, nothing has changed. We keep getting the confirmations that short in the top strategy is the highest probability right now. Short the bounces that happen on low volume. And if you're keeping track of a particular stocks, just start keeping track of them. What's the volume at 6 a.m.? What's the volume at 8 a.m.? What's the volume at 9 a.m.? So you have a reference point. What is the low volume? What is the high volume? Number 3, buy puts at the open, but don't load up. Just stair step. Buy a few contracts, pick up a few more later in the day, depending on what the market is doing. Ideally, you want to add the puts all the way up to 29.49, 29.50 level. Cut the losses if we break above 29.50 on strong volume. But remember the key levels. If we're breaking below 29.10, add puts if you see strong sell volume. Okay, so watch these key levels that we discussed earlier. Overall, today could be sort of a pause day. We may not get a significant break lower, may not get a significant break to the upside. We could be basically side trending between 2900 and 2930. So in this situation, okay, what you want to do is you want to save some capital. You want to make sure you have the capital for tomorrow. You have the capital for Thursday when we're going to get clear signal that the big move is coming. Right now, we are getting signals of this move, but there's still today could be a day when the market is going to pause and it's going to look like things are compared to yesterday. They're just not moving as much. Get ready. Guys, position yourself correctly. Take advantage of this market. The bigger drop is coming. Let's have an awesome day.